Welcome back. Now it's time for top picks. Let's start with Granite REIT. Where do you stand on this business?
Yeah, this is a stock that we've owned for a long time. That's normally in the dull, boring, safe camp, but it's got some European exposure, which the market has sold the stock off over the last 6 months because of that. That being said, European real estate from an industrial standpoint, we're talking like, we're FedEx buildings, Amazon buildings, e-commerce is still very strong and growing, undersaturated in continental Europe. So, and with index to inflation contracts. So we really like that side of the business. They can borrow over there quite cheaply. So we think the stock's been punished way too much. And at this point, where I think we're entering the end of the conflict, and with the euro raising interest rates, I think the depreciation in the euro, the major depreciation is behind us. So I think this point forward, things will get better, and you'll see a re-rating to approximately net asset value on the stock, which is around $95. So I think it's having a good day today, but it's been unduly pressured, and you get a 4% dividend yield as well. So I think this is a stock you could potentially make 15 to 20% over the next 12 months.
Okay, that's great. Next, we've got TransAlta. Tell us, why do you like this one?
Yeah, I've liked TransAlta a lot over the last 3-4 years. It was mispriced when it was down to $6 or $7. It's doing what it said it was going to do, get rid of the coal plants, bring on more renewables. It's starting to get more value for its hydro assets. They did a deal with Brookfield a few years ago. I like the fact that Brookfield has 2 board members and a significant equity stake in the company. I think that you get good intelligence when you're sharing ideas with Brookfield. They're smart people, and they're buying businesses around the world. They know they're on the pulse of what's happening in the power, infrastructure, and renewables area. So that's good sharing of information. The stock's down about $2 over the last couple of months. They had a bit of a soft quarter. I'm not too fussed about it. I think things will get better in Q4 and into next year. So here's a stock. Again, it's not a high-risk way to get exposure to the equity markets. You're getting a bit of a dividend. They're starting to grow the dividend here, and I think it should be in the $14, $15 range, not in the $12.50 range. So again, a stock that I think you can make 10 or 15% plus your dividend. And you never know. One day, maybe Brookfield takes a greater stake in the company, but I wouldn't buy it for that. But there's always that option down the road.
That's great. Well, Credit Suisse has also sort of echoed that sentiment about the opportunities in Europe as well as U.S. in terms of exposure. When do you think investors will really see those gains if they're entering into this play today? Do you think that's something that's over the course of the year, or it could be a year and a half, well into 2023?
I suspect it's going to be sooner than most. I would suspect it's going to be over the coming months. Perhaps before 23. Usually the stock market bottoms 6 to 9 months before we see earnings troughing. And I think earnings will get worse. And I think they'll trough in Q1 or Q2 of next year. But 6 to 9 months prior to that means we're into that sweet spot now. So I think you got to get your shopping list and start buying, if you want to buy a position in a stock, or you've got a lot of money to put into the market, you could kind of put 25% to work now, October, November, December, maybe save a bit for January. Start legging it in on weakness, because I think the setup for late 23, 24 is a lot better than we're in right now. I think inflation will be lower. It's not going down to what we've been used to, but it's a pretty good setup.
Okay, the next one has been seeing a bit of volatility price-wise. Tidewater Midstream. Why do you like this one? Yeah,
it gives me another way to get exposure to energy infrastructure, which I really like. Whether you want to talk energy security or energy transition, we still need to move molecules around. And whether it's hydrogen molecules in the future or whether it's natural gas now. Valuation on Tidewater is about 6 times EBITDA next year. Keyera, for example, and some of its larger competitors which should trade at a premium, but they trade at 10 or 11 times. So I think Tidewater, if they can execute on their Pipestone facility, their second phase of growth, plus they own a portion through Tidewater Renewable, which is another stock, LCFS, that they spun out. But they own part of the Prince George refinery through that, which is going to be producing renewable diesel next year. So if that can get executed, this stock will have a re-rating. And even if it trades at an 8 times multiple, that means the stock's probably $1.70, not $1.25 where it is now. So, and you get a 3% dividend yield. So here's one that's a bit of a value play here. So out of the 3, this one probably has the most upside, a little more risky, but even TransAlta and Granite, I think you can make 15, 20% next year. And we're trying Tidewater, you're hoping for 30%.